against US companies. Okay? Now here, assume that the dollar is presently weak and is expected to strengthen over time. How will these expectations affect the tendency of US investors to invest in foreign securities? So in this case, if you are a US investor, okay, so let's say right now you can buy €1 for 1.1 US dollars. Okay? So in this case, if you invest in Europe, and after some time, the value of the US dollar has gone up to 1, what that means is that when you convert your money back into US dollars, you're going to get less money. And the reason being that the US dollar has appreciated against the foreign currency. So in such a scenario, if you are a US investor, you will not want to invest in foreign securities immediately. And the reason being that you are buying the foreign currency, or you are investing in the foreign currency when the price is high, and when you get back your money, the foreign currency is going to be relatively weaker against the US dollar. Okay? Now, the next one, explain why a stronger dollar could enlarge the US balance of trade deficit. Explain why a weaker dollar could affect the US balance of trade deficit. So I think we already talked about this, and what we are saying was that typically a stronger dollar can enlarge the US balance of trade deficit, and the reason being that US companies would want to buy more products from outside because it's relatively cheaper, and in this case it also makes US products less competitive in the international markets, and that's the reason why the balance of trade deficit would go down. Okay? At the same time, what about a weaker dollar, how it can affect the US balance of trade deficit? So typically a weaker dollar can actually reduce the balance of trade deficit, and the reason being that here there could be less imports by US companies, and US companies will be able to export more to other countries. Now we want to talk about the factors affecting the direct foreign investment. So in this case, the first one is changes in restrictions. So sometimes what you see is that when the economy of a country is not doing that great, what they might do is that they might relax the restrictions. They might encourage foreign people or foreign companies to invest in their country. And how can they do that? One of the ways they can do that is they can basically say that a foreign company can invest in the US, let's say a foreign company can invest in their country without having a local partner, or they can invest in the country, they can take a majority share, and so on. So these are some examples of the changes in the restrictions that can encourage the direct foreign investment. The second one is privatization. So what is privatization? That talks about the process where sometimes government-owned companies are sold to the public. And in this case, by doing that, they are encouraging private investment in those government companies. And especially if they allow the foreign people to invest in those companies, that can encourage the direct foreign investment. Okay? The next one is potential economic growth. And here, during the last decade, people always talked about Brazil, Russia, India, and China. And the reason why people talked about these 4 countries, these are referred to as the BRIC countries, is because those were the fastest growing countries at the time. And what we saw was during the time period, there was a lot of investment made by other countries in these 4 countries. And the reason why they did that was because of the high growth prospects of those 4 countries. Okay? Now the next one is tax rates. So factors affecting direct foreign investment. In this case, what we are saying is that when a country has a lower tax rate, typically that can encourage direct foreign investment. So one example is Ireland. A lot of foreign companies are either moving their operations to Ireland or they are establishing their headquarters in Ireland. And the primary reason for doing that is because of the lower tax rates offered by Ireland. So Ireland wanted to encourage direct foreign investment, and one of the ways they did that was by bringing down their tax rate. And the last one is exchange rates. And in this case, what we are saying is that when a currency of a country is relatively weak, typically that can encourage direct foreign investment. So for people from other countries, it's relatively cheaper to buy and to invest in those countries. Okay? Now here, it talks about the global direct foreign investment across regions in the 2007 to 2008 period. And what we see here is that the most investment during that time period was in the US, 16.58. After that, we have UK, 11.1. We have France, 11.39. We have Japan 3.6, China 0.84, and so on. So what we see here is that even in 2007-8, the biggest investment took place in the US. And what are some of the reasons why the biggest investment took place in the US? The main reasons are, at the time, the US dollar was relatively low, and at the time, it was relatively cheap to buy US companies and to make investments in the US. And another reason is that, all said and done, the laws in the US typically offer protection to investors. And this is especially important to investors from other countries. Okay. Now, what about international portfolio investment? What are some of the factors that affect international portfolio investment? So the first one is tax rates on interest or dividends. And in this case, what we are saying is that when the tax rates are lower, it means that people from outside are going to buy more of your securities. That could be investing in bonds, or that could be investing in stocks, and so on. The next one is interest rates. So if your country offers relatively higher interest rates, that can again encourage more investment from abroad. Okay? And the third one is exchange rates. And here, what we are saying is that if the country's currency is relatively low, it also can encourage investment from outside. Okay? So these are the three factors that can affect the international portfolio investment. Now, the last thing we want to talk about is, we want to talk about the effect of foreign investment on the US bonds, how it can affect the US interest rates. Okay? So we have a couple of graphs. So the first one, it talks about the amount of funds that are available to be invested and how it can affect the interest rates. So we are talking about the interest rates, and we are talking about the bond market and how it can affect the business investment in the US. So from the previous class you took from corporate finance, you know the relationship between bond prices and interest rates. And essentially what we said was, typically when there is more investment, when more people want to buy, let's say, a bond, chances are the price of the bond will go up. And what happens to interest rates? So as the price of the bond goes up, the interest rates that the company is giving you is going to go down. So what we know from the previous class is there is a negative relationship, or there is an inverse relationship between bond prices and interest rates. So as bond prices go up, the interest rates that we receive will go down. Okay, so that's what we see here. In this case, as the demand, what we see here is that the amount of funds available is going up as the demand goes up. Okay? So we have the demand curve here, and we have the supply curve. So what is going to happen here is that when you look at the supply of funds, okay, initially only if the US investors are able to invest in US bonds, what we see here is that we have the supply curve is, supply of funds is given by S1, okay, and the demand for funds is given by this line, and they intersect here, and the interest rate is relatively high. And the reason why the interest rate is relatively high is because there is less demand for these bonds, and the price of these bonds is relatively low. Now what happens if people from Japan and people from, let's say, China are allowed to invest in the same US bonds? So in that case, what is going to happen is that there is more supply of funds, and when there is more supply of funds, it basically means that there is going to be a higher demand for the US bonds. And the benefit is that when there is a higher demand for the US bonds, the price of those bonds is going to go up and the interest rates are relatively low. So what we find here is that by having a higher investment or by allowing the foreign people to buy the US treasuries, the benefit is that the price of the US treasury is going to go up, and in this case, the interest rates on those bonds will go down. So the benefit here is that as far as US companies are concerned, typically the interest rate that they have to pay depends upon the US interest rates, so the interest rates on US bonds. So all said and done, they will be able to borrow money at a cheaper price, and in turn what that means is that they will be able to lower their financing cost. Now the last topic we have here is that we want to talk about the agencies that facilitate international flows. So what are the agencies that facilitate international flows? The main agencies are, we have the International Monetary Fund, we have the World Bank, and what do they do? Typically their role is to help countries, especially when they have some problems. So for example, some of the Asian countries had fiscal problems at one time or another. So India had problems, we had countries like Indonesia and so on had financial problems. So at that time, the International Monetary Fund, they come in, they are able to lend money to these countries, and usually when they give the money to these foreign governments, one of the things they try to do is that they try to make sure that these foreign governments, they try to make adjustments, structural adjustments that will ensure that these crises does not take place in the future. So that typically tends to be the role of the World Bank and the role of the International Monetary Fund. Now, what about the World Trade Organization? The main role of the World Trade Organization is that they tend to act like the court when there are disputes. So as an example, the US government sometimes files a dispute against China. They have filed disputes against India and so on for unfair trade practices. And whenever there's a dispute, that typically goes to the World Trade Organization, and then they tend to pass a judgment, and that can basically at least reduce the frictions between these trading countries. Okay? So that tend to be the role of these organizations.